in a second, I'll introduce our pensions rep, Mark Taylor-Batty, but I just wanted to start off by saying that I think that pensions can seem very confusing and difficult and complicated. And I think that people like the USS board have a tendency to make it seem overcomplicated so that people go, oh, this is all way beyond me, I can't cope with this, they must be right. I don't think we need to let them get away with that. So I thought I'd start off, might be stealing Mark's thunder here a little bit, sorry Mark, but I thought I'd start out with a very simple sum. I think there's a lot of talk of a deficit, and it's easy to think that that means that there is a real financial problem right now, that USS is having trouble paying out the pensions that it needs to pay to pensioners from the contributions that are coming in. That is not the case. So very straightforward sum, which is that contributions coming in are around about 2 billion a year. 2 billion, it's an enormous scheme. So what we and our employers are paying in is about 2 billion a year. What's being paid out is less than that. What's being paid out in pensions every year is less than that, and has been for the last 20 years. So contributions are continuing to exceed payments out. So there's not an immediate problem. But also, you may know, USS has assets of 80 billion. So if we were all to stop paying in right now, a simple sum would be they could carry on for 40 years paying pensions without any more contributions coming in. So this deficit is not right now. And Mark is going to explain a lot more about that. But I thought it'd be helpful to just give that very simple sum at the beginning. So I'll shut up now and pass over to Mark, and he will talk a lot more about the valuation. Thanks, Mark.
Thank you, Ben. Yes, pensions are complicated, but there are some very simple ways of understanding what's going on. First, I want to reassure everyone and remind everybody that everything that you have accrued to date in your pension is secure. Nobody is talking about changing what you will get from what you have already put in. So if you're close to retirement, your pension is what you are expecting to get. So there's no retrospective change of what you've already accrued. From that point of view, those of us that had a final salary up until 2016, that part of our pension remains, and we will get that final salary as calculated in 2016, in addition to what we've accrued since then, which will be retained. So please don't worry that anything that's going on means your pension is at risk. But of course, the younger that you are, any changes that might take place, it will be detrimental or could be detrimental to the pension that you could get relative to what it would be on the current basis. Now, okay, so I was invited to talk with the Vice Chancellor when she was giving her talk on the pension situation in the last couple of weeks. It's great that the UCU for the first time ever was invited to that kind of talk and recognised as being the people who represent all members of USS, not just UCU members, and we were very grateful for that. I was only given 3 minutes to talk, and we were told I couldn't use a PowerPoint, so any of you who saw that knew that I had to throw some charts up behind me as a mean of trying to illustrate some of what I was talking about. It's very difficult to talk about this without illustrating that. So I'm going to continue in that vein and do the same now. If I could just pull up my slides behind me, and if I could be spotlit. Hey, there we are. So Zoom allows me to do the same thing, which is to use slides as a background. So I just want to talk a little bit about the current situation. I am going to be showing some charts and talking about some figures. I know that sends some people to sleep, but I just want to, as I say, it's important to illustrate what's going on against the history of what's gone on so that we have a full understanding of the situation. But where we are now is that the USS last week released its what's known as the 76.1 report, which is its valuation. This is the 2020 valuation, is this report. And within that, it's offered people, the employers, 2 scenarios for maintaining the current benefit structure, which is to say the hybrid model that we have, which is a defined benefit career average pension up to a certain amount of salary, and people earning more than that will have that, plus above that a defined contribution pension in retirement. just to keep up with that, a defined benefit means that you know how much you will get in retirement. You know what the pension is. The benefit, the pension, is defined, and it's defined by a certain calculation based on your salary. A defined contribution means you only know what you pay into that pension. You have no clue what you will get out of it. Just a reminder on those two very, very clear principles. So we have a hybrid scheme with the defined benefit up to, I think it's about £59,000 salary, and above that, you keep that salary, but you keep that pension below that salary. Above that, you get a defined contribution, which is basically your money is invested in the stock market, and you'll get out of that however much it grows proportionately. So in order to keep that situation, the hybrid model that we currently have, the USS are telling the employees that the contributions from us and them need to increase to 42.1% of salary, or up to 56.2% of salary. Now, currently, to put that in context, we're paying 30.7%, which is, from our point of view, 9.6% of our salary. So these complete contributions, we pay a third, employers pay 2/3. So at the moment, we're paying 9.6% of our salaries, and the employers are paying the rest. In October, that will go up to 34.7% of salary. So from October, we will be paying 11% of salary into our pension, and the employers much more. That was part of the 2018 valuation. To put that in even further context, before 2018, the total was 26%, and we were paying, what was it, 6 point something? I can't remember now. So so that's how it's escalated. Now, look at those figures: 42.1% of salary, or 56.2. The reason why there is a difference is that the USS have said to employers, if you strengthen your covenant, and the covenant is the ability of the universities collectively to cover any shortfalls, should any shortfall happen in the future. If you strengthen that covenant, we'll say 42.1%. Thank you very much. If you refuse to strengthen your covenant, this is USS's perspective, we're saying 56.2% is the contribution rate. Now, I want you all to think of what 56.2% of your salary is. And think about the kind of pension, if you've done the valuation, that you are looking at. So somebody on I don't know, 40 grand, say, a salary, they're suggesting that more than £20,000 a year would need to go in for them to get that £16,000 in retirement pension that is probably being is the valuation that kind of person might have, somewhere between 16 and 20 possibly, depending on how many AVCs they're paid in. That seems ludicrous immediately, doesn't it? That much money has to be paid in over that many years. What they're saying is, give us all this money and we will lose a lot of it. Why are they saying that? Why are we where we are now? I'm going to answer this, or start looking at some of these issues around this as I move forward. Now, the Joint Negotiating Committee, which is a committee made up of both UCU and UUK members, and this is primarily one of the reasons why UCU represent all members of the scheme, because they are the body at the Joint Negotiating Committee. They now have 90 days, 3 months, to respond to the valuation once it has been effectively and formally delivered, which it was last week. So there's still time for manoeuvre and negotiation, but the USS are setting some very, very rigid kind of parameters into what might be possible. The JNC is the body that will decide what the contribution levels will be, or what the change to benefit structure would be as a consequence of what's been delivered in the valuation. And they've got 90 days to come to that. But yesterday, just as I was finishing off my preparations for this talk, the UUK requested a review of the valuation, and I'll talk more about that later. I've had to rewrite my talk as a consequence of that, because that really does, that's a really very interesting and I think welcome development. So I'll talk a little bit about that at the end of what I've got to say. Let me just go back to some of these charts and some of these stats. So this is an illustration of what Ben was talking about, where contributions coming into the scheme have always been higher than the benefits payable. That is to say, all our money coming in from you and me and from the employers has been greater, not just the last 10 years, not just the last 20 years, it has always been greater in the history of the pension than the money going out every year. And Ben got her figures slightly wrong there. There's nearly 3 billion coming in every year at the moment, not 2, but there is just about just under 2 billion going out. And you can see those lines are diverging. They're moving apart. And one of the reasons they're moving apart is because we're paying more in as a consequence of recent valuations, but not more is being paid out. That's not necessarily flatlining, but it's staying at a steady state. Putting that into further context, and this is one of the images I had behind me when I was talking with the Vice Chancellor. So look at those benefits payable in the grand scheme of things. The money going out every year is flatlining here, moving up to 2 billion along the bottom. Whereas up at the top is the value of the assets. So that's all the money that the pension owns, coming up to, in this chart, 68 billion. That was the last report in the March 2020 report. Since then, it's gone up to 80 billion. So you need to imagine that blue line going high up at the end there. So the current value of the assets are 80 billion. So as Ben says, we now have enough to pay the pensions at the current rate of 2 billion for 40 more years without paying anything else in and without having any more investment, interest growing or return on investments. Forgive me, I'm just going to go through the history here because I think it's important that we understand what has gone on in the last 10 years. And I'm borrowing charts from Sam Marsh's presentation. I'll just get through these quickly, but I just want to take us back 10 years to the 2011 prudent assumptions. That's the dotted line above me here. And the actual asset growth went much higher than what they said it would do. It was 2011, it was on the basis of those prudent assumptions that the final salary aspect of the scheme was closed to new entrants. And look, it was wrong. Go to 2014, you will see that line now, the smaller dotted line moving away, another prudent set of assumptions saying this will not grow much further, but it did. And at the 24th, that base of that, on that assumption, we closed final salary altogether. And that closed in 2016 as a consequence of that inaccurate, by a long mark, assumption of growth. Here, now, as you see, the growth line just continues upwards. The two lines that are pointing out towards the top there, the two dotted lines, are the 2017 assumption pointing downwards, and then the 2018 assumption that replaced it, you will remember, as a result of our action. That's still wrong, but on the basis of that 2017 set of highly inaccurate assumptions, they were talking about closing the direct benefit altogether, you will remember, and that's why we went on strike, and very effective strike as it was. In 2018, we had further strike action because of the proposed increased contributions up to 11%, as I talked about earlier this October. And yet the assets still grow. 2020, the financial management plan showed this downward, that the most prudent assumption of the growth of the assets going forward. Let me expand that out to 2041. So all of these lines now are all of these assumptions we've had in the past 10 years, including this downward pointing one now, which is the latest one, where effectively USS are saying, give us your money, we will lose it. We will turn 80 billion into 50 billion in 20 years. It makes no sense. And there's been a lot of scrutiny by mathematicians of the figures to try and find out what's going on here. And it seems peculiarly this time, what USS have done is, instead of setting their prudence rate, instead of saying, how cautious do we want to be about things like growth and mortality rate and what have you, which is what all these other lines have been generated by, what they've done this time is said, we will set the growth rate at around about CPI, and let's see what prudence rate that creates. Well, it creates this excessive prudence. And what's interesting is that this line is effectively saying our assets will never be worth 80 billion, and yet they are worth 80 billion. Interestingly, if you follow the line across from 80 billion here, you will see that the 2011 assumptions told us we would not get this far in our asset growth until 2031. The 2017 one said it would take till 2045 to have as much money in our scheme as we currently have. That's a very big margin, a very significant error upon which significant changes were made to the structure of our pension on those bases. On that, I just want to take you back a little bit, and this might make some people angry. Forgive me for this. This is the 2008 prudent assumption, pointing upwards, the dotted line. And of course, 2008, 2009, we were hit by the financial crisis. So it wasn't prudent enough in the short term, but look where it is now. We have beaten, in the growth of the assets, have beaten the 2008 prudent assumptions. And of course, assumptions have to be long-term, not short-term. What did the 2008 valuation say? It said we could afford to keep the final salary pension. We could afford to keep the final salary pension. On that basis, we could still afford to keep what we had 10 years ago, on the basis of the assumptions made then. Okay, this is all very frustrating. It seems like there's been a 10-year campaign to destroy our pension by repeatedly and increasingly excessive prudent assumptions of what will happen in the future. Okay, so these are all of them together. Now, some people would say to me, to talk about the current rate of assets and the current benefit payable is naive. That's not how evaluation takes place. Well, that's true. It is naive, and that is not how evaluation takes place. But it's a very interesting snapshot of where we are and of what we could do. If we could lock that money in a room and only touch it to pay benefits payable, we know we could afford to do that. That's kind of how evaluation used to take place before the 2004 Pension Act. What the 2004 Pension Act has brought with, along with a pension regulator, is this increasing need to value a pension in the way in which it is now valued, which is to say, what they now do is to say this is the amount of money we've got. Is this enough to pay all the pensions that have accrued to date? And when they assume that it is not, that's when we have a deficit. Now, of course, they don't know exactly how much the pensions in the future are going to cost. So they have to use a range of assumptions in order to guess how much all those pensions that have accrued to date are going to cost in the future. And in order to do that, they throw in assumptions like increase in salaries, mortality rates, how many people how long are people going to survive in retirement? And of course, importantly, the growth of the assets, how fast will the assets grow in the market? Against this, we have the issue of the decision to de-risk the assets. You may have heard this in previous pensions, and again in this one. De-risking the assets means selling shares, stocks and shares, and buying bonds and gilts instead, because when you buy bonds and gilts, you know how much you will get out in the long term. So it's secure from that point of view. But of course, bonds and gilts pay out much, much lower amounts in the long term than stocks and shares do historically. So when you're de-risking the assets, you are increasing the deficit, because you know you will get less out, you know how much you'll get out, but it's less than you traditionally and historically get out of stocks and shares. And of course, ironically, that's the last thing you want to do in a defined contribution pension. You want to increase the amount of money you're going to get out in a defined contribution pension. So there's all sorts of issues here that I can explain later if people have particular questions. I just want to show one further chart. This is Sam Marsh's extrapolation from the March 2020 numbers that USS have given of the break-even rate, which is to say the rate of growth going forward that we would need in order to keep the benefits as they are, and keep the contribution rates as they are. As you can see, it's still very, very prudent. It's more prudent than many other valuations before it. It probably also defines a deficit. I can't confirm that, but it's quite likely that it does confirm a deficit. And yet no change would be needed. Would we get this if we petitioned for a change in the valuation? Probably not, but it does show that the figures themselves dictate that there are scenarios where no change is needed, depending on which set of assumptions that you use. Okay, so where can we go from here? What is the situation now that they are saying potentially universities and employees together have to pay up to 50% of salary, more than 50% of salary, in order to keep the pensions that we currently have? That's very, very clearly trying to force our hands. And it avoids the very serious questions about how they have come to those conclusions, which they're not being fully transparent around, to everybody's annoyance. So UUK, the body that represents the employers, and UCU are singing from the same hymn sheet on this. You know, we are talking the same language in terms of asking questions around this. And I'll talk about the UUK's letter in a minute. But there are a number of angles that we can take. Of course, industrial action is always a last resort that we can use, but we can only use it against the employers. We can't use it against USS or UUK more broadly. We can only, as an institution, use it against our own institution if they have failed to do something which we might deem as necessary to secure our pensions. And of course, that is a last resort that is in the bag for further down the year. But there is time. As I say, there's 90 days. The pension regulator has already recognised that this could take longer than the usual deadlines that will be required on evaluation. There's lots of talking still to be done. So the political work, the negotiations have only just begun in a way. I mean, they've been ongoing, if you like, for the last year as the figures have been coming through, but they've now tightened up and heated up. There are legal resorts as well that need to be explored by the union and maybe even by UUK. So one, for example, is that it is within the rules of the scheme that the scheme actuary presents their opinion to the JNC. Arguably, that has not happened. What the JNC has got, the advice of the actuary funneled through the USS. So there is one argument that can be made and could well be made soon that says we haven't got the valuation yet because according to the rules of the scheme, we have not heard the actuary's opinion. And it'd be very curious to know which actuary, well, we know which actuary is, but which actuary, you know, what actuary would put their reputation behind these kind of figures? So there are certain pressure points that we can still pull from that point of view. But let me look at the political side of things, because usually in the past, UCU have been singing on their own on this. And now it seems that UUK have entered that fray. And, you know, with our support, with UCU support. I know that UCU and UUK were meeting last week and they're meeting again, or they were meeting again this morning. So this is the Financial Times headline that came out yesterday evening around about 4 o'clock or 5 o'clock. Actually, it's 6:45, I can see it says there. Okay. So what happened is yesterday is that UUK wrote letters to both USS, the pension scheme, but also to the pension regulator, and made them public. So it may well be that these kind of correspondence have happened in the past and not being made public. But this is quite a move. We've never seen this kind of maneuver from UUK before. And that's very telling. Our university seems to be an outlier within UUK. And this reminds me of back in 2018 when Alan Langdon sent us all an email. I'll remember it very well. We were all in the middle of very heated industrial action. We had just rejected the ACAS solution to the 2017 valuation. And at 4:20 on the 23rd of March, our Vice-Chancellor Alan Langdon sent out an email saying he supported the ACAS solution and it was a credible way forward. And then 2 or 3 hours later, UUK made an announcement that they were going to pause that, they were going to form the JEP, and that there was going to be a 2018 valuation coming instead of the 2017. That was very interesting then, that it was very clear that our Vice-Chancellor wasn't in the loop on that conversation with UUK. And here again, we have a university that seems to be speaking separately from what UUK is doing, rather than being part of UUK. I don't know quite how to read that. It may be to do with the kind of people who are briefing our Vice-Chancellors and the kind of opinions that they're taking. but it's interesting that that things have overtaken the kind of statements that the Vice-Chancellor here was making. Let me look at the detail. Before I close, I just want to look at the detail of some of what's in these letters. Before I do that, this was a statement that was released last week, which I referred to in the last meeting with the Vice-Chancellor, that this was in a question and answer document that was sent by UUK to its member institutions. And just the question itself is very telling, isn't it? Why would you even put that question in a QAA document? Do employers have confidence in the USS trustee? And the answer is lukewarm, isn't it? We recognise that this is a complex area. The USS trustee has difficult decisions to take and often comes under competing pressure from scheme members, the UCU, individual employers, UUK, and the pensions regulator. We are questioning the USS trustee's current interpretation of specific technical matters related to covenant strength and pricing, and not its overall suitability to govern the scheme. So the issue of trust is down to that issue of current interpretation of specific technical matters. In other words, the valuation. Do we trust the valuation? They were saying last week. And then yesterday we get the detail there, we get the flesh on those bones. So let me just give you some choice quotations from the letter from UUK to USS Pension. This was released yesterday afternoon. We have not received strong or clear justification for the very high pricing decisions, and as such, employers are very concerned that the scheme is facing an unnecessary and unjustified level of reform. UCU could not have put it better: unnecessary and unjustified level of reform. Interesting. We find this pitting of stakeholders against each other to be unhelpful and opportunistic, given market conditions at 31st March 2020. That's a reminder that the valuation and the estimation of asset returns going forward is based on the market chaos, the unique historic market chaos of March 2020, just after COVID had hit and the market sank, understandably. But this notion of pitting stakeholders against each other, that's UCU and UUK, that USS is being accused of manipulating that risk of industrial action that UUK have to respond to. We are also concerned the USS trustees' position in the valuation outcome is entirely down to the employers. Fundamentally, it is down to the USS trustees' own decision-making about the price of benefits and the value it proposes to attribute to additional covenant supporting measures. I can speak about the covenant and the covenant supporting measures later if that's interesting to people, if there are questions around that. As I say, what USS are saying is, support your covenant, give us more commitment to paying off the debt in these ways, and they give them details of ways. And if you don't, you'll have to pay more. Okay, I can't help but quote a few more things here because it's a very, very significant and important letter. There is concern that the position the USS trustees has adopted takes very little account of UUK's technical provisions consultation response and appears to be largely unaffected by the evidence presented in the valuation methodology discussion forum and the views of UUK and UCU representatives who attended that forum. So you're not listening to us. We've got evidence that you are not listening to us, is what UUK is saying, and it's what we've been saying for years. And it is true. We have these consultation processes. We set up this valuation methodology discussion forum, and it's just wind in the background with absolute no bearing, just like they've ignored the recommendations of the joint expert panel that was set up in 2018. So the real frustration being expressed here. And again, some of the decision-making process, some of the decision-making and process from the USS trustee looks odd to employers, including the extent of the influence of TPR, the pensions regulator, in this valuation compared to previous valuations. So finally, there's this expression of concern that the pensions regulator is interfering above and beyond their remit, as we've been saying, I think, for a while now. And I talked earlier about legal challenges. It would be within the bounds of reality for the USS to challenge legally the TPR. They never will do, because they're using TPR as an excuse for what they're doing. I just want to look now at the letter that was sent by UUK yesterday to the pensions regulator, because that's also interesting, that there's a challenge to the pensions regulator. We are particularly concerned about the influence of the pensions regulator on the USS trustee in the build-up to the release of the Rule 76 report. Remember, the Rule 76 report is effectively the valuation, the 2020 valuation that dropped last week. From the information provided by the USS trustee, this has moved the pricing into a range where no proportionate or justifiable outcome can be reached by the valuation. Proportionate or justifiable. Given that the pensions regulator does not have a formal role in setting employer or employee contributions for the USS, it is vital that you allow the stakeholders enough space to find a solution, rather than imposing any hard constraints ahead of stakeholder discussion and consultation. So that's the UUK telling the pensions regulator to butt out. This is not within your remit. Stop it. Don't do this. And if you remember those charts, let me just quickly zoom back to those charts. All of these prudent valuations that we've had in the past, every single one of them, the pensions regulator has said, this prudence is at the limit of tolerance, limits of acceptability, and yet they just change. We hear the same statement from the pensions regulator every time, because of course, their job is to try to increase prudence, is to try to limit defined benefits pensions and promote defined contributions pensions, because then they don't have a job to do. They don't have any protecting to do with defined contributions, because we don't know what pensions we'll get out of that in the long term. Okay, so that brings me back to where do we go now? Well, what I was going to say before the letters came out yesterday is very different, I guess, to what I've got to say today, because today we've got to wait to see. It's like kind of sitting in the background and watching the fight happen and seeing who's going to win. We need to wait to see what's going to happen before we do anything. But of course, we are part of that. We are UCU are part of that discussion. As I say, UCU and UK had a discussion this morning. UCU are wanting to talk to the pensions regulator as well as UK. And of course, as part of working together on the joint negotiating committee, the JNC, that will effectively have the task of setting contributions and or changes to benefit structure, it seems that we're not having it. One outcome might well be a new valuation, and it does seem to be that the UK is pushing at that, is saying, no, you can't base a valuation on the market chaos of March 2020 and expect us to swallow that. We've seen the market surge since then, and the value of the assets have gone up 15% in 11 months. And there's no sign of the market going down. On top of that, the gilts market, as I mentioned earlier, are the things that they peg future growth on. They don't peg future growth on what the assets actually are. They peg them on gilts, and gilts themselves have risen in the last month. They don't seem to be talking about that, do they? They don't seem to be considering how wrong the valuation numbers are already seeming to be. Okay, there's plenty of areas of discussion now, and forgive me if I've spoken longer than I intended, but we should now go on to questions and further discussion.
Thanks, Ben. So up until I think it was May last year, I was chairing the team of negotiators as the vice president. I don't do that anymore as the president. That's Justine Mercer, and Sam Marsh, you've seen some of his graphs today, is the vice chair of that group. I am obviously still in quite close contact with them, so I know how hard they've been working, and I actually just want to take a moment to underline that Justine as vice president gets a small amount of buyout from her role for the entirety of being vice president, but gets no extra sort of time released for this work that she's doing on USS, and the rest of the entire negotiation team get no release of their time from their jobs, and yet are in so many meetings and fighting so hard. I really just want to pay tribute to that, because I know how much they're doing. They have multiple meetings a week at the moment on this, and it's testament to how hard they have been pushing, I think, and how hard they have worked to bring the employers to the position that they're at the moment. But that itself, I want to stop and recognise, is backed by our members having been willing multiple times to make clear that they're ready to take and have taken action to defend our pension scheme. And I think that really has helped to shift the scope of the narratives and the space in which we've been having these discussions. And there have been a lot of very technical discussions. So the letter that Mark shared and has read extracts from the employers that has gone public makes reference to things like the valuation methodology forum, to technical discussions. We have had multiple strands of negotiation formally. We have also had tripartite talks. We have had all sorts of informal discussions with the employers and between the employers and ourselves and USS over the past few years. There is a phenomenal amount of work going into this. And the way I read the employer's letter is quite interesting, because if you don't know what the people involved are like, and if you haven't been in those meetings, it could almost read as quite understated. The language in it is very icily polite. But actually, I read that letter and I see deep, angry frustration, because the employers' representatives have never enjoyed making public statements like this. They would much prefer that it was possible to sort some of these issues out in the background and not have to deal with this kind of thing at all. So the fact that they have put a letter into the public domain that is critical of USS and also is calling out certain aspects around how these things have been done and expressing frustrations with this process is really significant. And we have to recognise that is progress, but I think we also have to recognise that that doesn't mean that we're by any sort of sense of the word out of the woods with respect to where we are on the pension scheme, on defending USS. So we're in a much better place because of our members' willingness to defend the pension scheme and make clear that they were ready to. That has opened up those more positive discussions and has made it more possible for us to make progress. It shows how much of a difference it makes to the tone of these discussions when the employers are listening. But as is evidenced by the, let's say, uncertainty and maybe slight edge of unwillingness, there is not a unified position necessarily among the employers. There are still divisions, and I'm a little bit concerned about who it is within the employers group that our Vice Chancellor is talking to and is listening to. And I hope that she will have more discussions, more in depth, about what lies behind this letter and the frustration that is there. And, you know, we are doing things that a few years ago we were told were impossible. For example, having meetings with the regulator, we were told that wasn't possible. So there's a lot on. There's a lot more to come. We need to be ready to react, and we need to be ready to support our negotiators further. There is going to be another sector conference coming up actually quite soon. It feels like it's quite soon because we had a delay on our most recent one owing to COVID. But in the end of May, start of June, we have another higher education sector conference where there will be motions about USS and the next steps that we need to be prepared to take. And we will obviously have had more of an update by then. I think I just want to end by saying, please see this as progress, but please don't see the employers having sent a letter this time as being the sort of signal that everything's going to be fine, because we need to keep working hard. And there are other concerns that I have around where we might diverge from the employers, particularly in terms of where they might sit on what changes need to be made to the scheme. You know, you'll note in their letter, they say that they are not saying everything needs to remain completely unchanged. So I think there are likely to be arguments, particularly around how early career and casualised staff are going to be handled and looked after or not with respect to this pension scheme. But I'll stop waffling on. But it's really important that we see the direct relationship between our industrial strength and the progress that have been made in talks with the employer.